Right now, as we look at the charts on this Tuesday morning, November 26th, Beyond Meat is trading at exactly 88 cents per share, showing a deceptive pulse with an intraday gain of roughly 3.14%. You are looking at a stock that once commanded the attention of the entire financial world, trading at triple digits, now fighting for its life in the sub-dollar cellar of the Nasdaq. That green candle you see on the screen, pushing the price up by roughly 3 cents, might look like a sign of life to the untrained eye. But do not mistake a muscle twitch for a recovery. We are watching a company that is currently balancing on a razor's edge between a total capital structure overhaul and the abyss of delisting. The market is currently pricing this not as a growth story, but as a distressed asset option. And that changes everything about how you need to trade it. Most investors looking at this chart see a tragedy, a fallen angel that has wiped out billions in shareholder value. They see the 88-cent handle and assume the story is over, that the bankruptcy lawyers are already drafting the filings. That is the expectation, total capitulation. But the reality is far more complex and significantly more dangerous for anyone betting blindly on either side. The reality is that Beyond Meat is currently undergoing one of the most aggressive balance sheet restructuring efforts we have seen in the consumer staples sector this year. They are not just bleeding out, they are actively diluting shareholders to pay off bondholders, effectively swapping debt for equity in a desperate bid to extend their runway. This 3% move today isn't about selling more burgers. It is about the mechanics of the float and the massive, coiled spring of short interest that is currently trapping bears who might have stayed at the party too long. When a stock falls below the $1 mark, it enters a psychological and technical no man's land. The narrative shifts from how fast can they grow to can they stay listed. You need to understand that the Nasdaq has strict compliance rules. Trading under $1 for 30 consecutive business days triggers a deficiency notice. Beyond Meat is flirting with this disaster right now. This creates a binary outcome. Either they execute a reverse stock split, usually a 10-for-1 or 20-for-1 consolidation that mathematically raises the share price but often signals weakness, or they manage to manufacture a rally back above $1 through a short squeeze or a strategic announcement. This tension is what is driving the volume you are seeing today. It is not institutional accumulation. It is a battle between high-frequency algorithms exploiting the penny spreads and short sellers trying to press the boot on the neck of the stock. Let's be real about the fundamental picture before we dig into the short squeeze metrics, because you cannot trade this responsibly without acknowledging the ugliness of the balance sheet. The plant-based meat disruption that was promised in 2019 has hit a wall of consumer apathy and inflation. The idea was that we would all be eating pea-protein burgers by now. Instead, inflation forced consumers to trade down to cheaper proteins, and the health halo of highly processed plant meat has been tarnished. Revenue is shrinking, not growing. In their most recent financial disclosures, we saw revenue down double digits year over year. They are burning cash to keep the lights on, and the gross margins have been decimated by lower volumes and high inventory costs. This is a company that was built for hypergrowth, now forced to shrink its footprint to survive. They've cut their workforce, reduced marketing spend, and are trying to right-size the ship. But shrinking to greatness is a very difficult strategy when you have massive fixed costs. However, and this is where the contrarian angle comes in, the market knows all of this. The disaster is priced in. At 88 cents, nobody is expecting a miracle. This is where the risk-reward ratio gets interesting for the speculators. When a stock is priced for bankruptcy, any news that is less bad than expected can trigger a violent upside move. If they announce a new strategic partnership, a refinancing deal that doesn't wipe out equity holders completely, or even just a quarter where they burn less cash than feared, the stock could double from these levels in a matter of days, simply because the valuation has been compressed so severely. The market is currently positioned for a funeral, so if the patient sits up and asks for water, the reaction will be explosive. This brings us to the most critical part of today's analysis, the short-selling dynamic. You cannot talk about Beyond Meat at 88 cents without addressing the massive short interest. Current data indicates that over 37% of the floating shares are sold short. This is an astronomically high number. To put that in perspective, anything over 10% is considered high. Over 30% is crowded. But here is the metric that matters even more, the days to cover. Right now, based on the average daily trading volume, it would take short sellers more than 14 days to cover their positions if they all tried to exit at the same time. This is a liquidity trap for the bears. If positive news hits the wire, or if a coordinated buying wave comes in, there literally aren't enough shares available at these prices for the shorts to buy back what they owe without driving the price vertical. We're also seeing elevated cost-to-borrow rates. This is the interest rate that short sellers have to pay to borrow the stock from brokers. When this rate spikes, it means shares are hard to locate. It acts as a tax on the bears. If the stock price stays flat, they lose money every day just on the interest. This creates a use-it-or-lose-it mentality for short sellers. They need the stock to drop fast. If it grinds sideways or ticks up like it is doing today, the pain of holding those short positions increases. This setup is a classic powder keg. We have seen this movie before with other distressed names. The fundamentals are terrible, but the technicals suggest that the shorts have overplayed their hand. A dead cat bounce in this scenario can easily turn into a 100% runner if the crowded short trade tries to unwind. I want you to pause for a second and look at the broader consumer landscape. We are seeing a shift where legacy food giants are struggling to find growth. There is always the lingering speculation that a major player like Kraft Heinz, PepsiCo, or a global meat packer might step in and acquire the brand for pennies on the dollar. Beyond Meat still has massive brand equity. The name is synonymous with the category. At a market cap that is shriveled down to these levels, it becomes a bite-sized acquisition target for a conglomerate that wants to own the intellectual property and distribution channels without building it from scratch. While you should never buy a stock solely on buyout rumors, at sub-$1 levels, the acquisition optionality acts as a floor. The brand is worth something, even if the current business model is broken. Now, let's talk about the retail sentiment. If you go on the forums, on X, on Reddit, the conversation has shifted from saving the planet to saving the portfolio. There's a lot of anger, a lot of denial, a lot of pain. But there is also a contingent of deep value investors who are accumulating shares here, betting on a turnaround. They are looking at the cash on the balance sheet relative to the debt and arguing that the company has enough runway to pivot. This creates a fascinating tug-of-war. The institutional money has largely fled, leaving the battlefield to high-frequency algorithms, retail speculators, and hedge funds playing the short side. This makes the stock incredibly volatile. You will see moves of 5, 10, even 15% in a single day on no news, simply because of liquidity gaps in the order book. I want to hear from you right now. Comment below how many shares of Beyond Meat you currently hold and what your average cost basis is. Are you down 90% and holding as a reminder? Or are you a new buyer stepping in at 88 cents trying to catch the falling knife? I really want to gauge the sentiment of the room, because usually bottoms are formed when the last retail investor gives up and sells in disgust. Are we there yet? Let me know in the comments. Moving deeper into the mechanics of what happens next, we need to discuss the fail to deliver, or FTD data. When short selling is this aggressive, you often see a spike in FTDs, which essentially means that traders are selling stock they haven't located yet. This can lead to forced buy-ins by regulators if it persists. Watch the T+35 settlement cycles. If we see a surge in FTDs reported by the SEC for the second half of November, it could signal that the selling pressure we have seen was artificial and that a forced covering event is on the horizon. This is technical market plumbing, but when a stock is trading for pennies, these plumbing issues become the primary drivers of price action. However, do not ignore the risks. The reality side of our equation is stark. If the company cannot stem the cash burn, they will have to raise more capital. Raising capital when your stock is 88 cents is toxic. It leads to death spirals where the company issues stock at a discount to the market price. The new investors immediately sell that stock to lock in a profit, driving the price down further, forcing the company to issue even more shares. It's a vicious cycle that destroys equity holders. We saw them convert debt to equity recently, which was a necessary evil, but it diluted the pie significantly. If you are buying here, you are betting that they can stop the bleeding before they run out of shares to sell. The operational pivot is the only fundamental way out. They are pulling out of profitable markets like the jerky line, which was a partnership with Pepsi.